Right, hi everyone. Welcome to today's webinar brought to you by Vantage Markets. Today we're going to have another central bank spotlight, this time on the Bank of England, which released its monetary policy statement on the 9th of May. Right, so once again, thank you for tuning in. I've been streaming directly into the Vantage app as well as over on Zoom. So do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. Right, before we get things going, right, let's quickly take a quick look at the disclaimer. Just let me check something as well. Just let me make sure everything's up and running. All right. Okay. Great. Right. Right. Yeah. Please take note of the disclaimer. Right. The information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter, and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin forex and CFDs. They carry significant risks and is not suitable for all investors. My name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between Vantage Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so just a simple agenda for today. So we'll take a look at what are the key takeaways from the Bank of England statement that was released on the 9th of May. This is the monetary policy statement. What are the key points that they highlighted? And then also we'll also take a look at was there any significant shift in messaging from the Bank of England, as well as Governor Andrew Bailey. And also we'll look at what does it mean for the cable moving forward, right? The cable is basically the currency pair that is the British pound, US dollar. All right, so this monetary policy statement was released on Thursday, 9th of May at 11 a.m. GMT time. And as widely expected, right, prior to this meeting or the release of the statement, as widely expected, the BOE left its official bank rate unchanged at 5.25%. Right, this occurred on 9th of May at 11 a.m. Now, this also marked the sixth consecutive meeting where rates were kept on hold. Right, what is quite important to take note of is that previously there were the majority had voted at the previous meeting, which was in March, I believe, had a majority vote of 8-1 to keep the rates on hold at 5.25%. However, this time round, although there was a majority vote once again, this time it reduced to 2. So there a majority vote of 7-2. And this time the number of members or MPC members who preferred to reduce the current bank rate increased from 1 to 2. So these two members were actually looking forward or were actually preferring to move forward with a rate cut. And that rate cut was going to consist of 25 basis points or a quarter of a percentage point. So this is somewhat of a dovish signal within MPC members as well. I remember previously you had a majority vote of 9-0, and then it became 8-1, and now finally it's come 7-2. So you can see there are more doves that are being building in the committee, and it's quite likely that this is the direction that they will take moving forward as well. However, when you take a look at some more at the macroeconomic data, with regard to inflation and GDP, where you can see 12-month CPI inflation fell to 3.2% in March, down from 3.4% in February. It's moving in the right direction. However, it is still well above the Bank of England's target of 2%. Right? The Bank of England has an inflation target of 2%, and clearly, headline CPI at 3.2% is still well above that target. Now, they're also expecting for CPI to increase in the second half of this year to around 2.5%, owing to the unwinding of energy-related base effects. Right, so especially the first quarter of this year, where we saw energy prices rebound as well, that's going to have an impact on prices moving forward as well, at least for the next for the second quarter, and maybe after that in the third quarter onwards, we may see prices start to taper off again, or energy prices. Now, looking at GDP, right? GDP has been weak in the UK, right? It's expecting to rise by 0.4% in the fourth quarter, in the first quarter of 2024, and it's expected to grow just 0.2% in the second quarter. Right, so despite picking up during the forecast period, demand growth is expected to remain weaker throughout most of that period. So while inflation is heading in the right direction, it is still well above the Bank of England's target of 2%. And at the same time, we can see that economic our GDP output in the first quarter has been relatively weak. And when we look at the GDP uh, chart later, right, we can see that we would also see that the UK actually entered a technical recession in the third and fourth quarter of 2023 and has actually rebounded quite nicely in the first quarter of this year. Now you can see here, since the 2022, the Bank of England has raised its official bank rate aggressively, right, going from about 0.25% to as high as now as 5.25%. Right, so there's still a margin of economic slack in the country, so that means GDP output is not as strong as it should be. And also we can see that, remember, everyone's highlighting that now there are two committee members who have preferred to reduce the rate cut. So there are more doves being formed among members, and that could have a major impact moving forward as well for upcoming monetary policy meetings by the Bank of England. Right, so this chart here shows the level of the interest rates of the bank rate from 2014 to present. And this is the chart from 2001 till present. So you can see here, prior to the Lehman crisis that occurred in 2007, 2008, you can see the Bank of England had kept its bank rate as high as 5.75% before cutting drastically as the financial crisis blew up all over, well, globally. Right, and then this is the opposite here. We can see a very aggressive hiking or steepening of the bank rate. Now, was there any significant shift in messaging from the BOE? All right, the major significant shift was we had an increase of members from 1 to 2 who preferred to have a rate cut, right, by 25 basis points. So basically, this was a dovish signal. So when this statement was released, it initially had a negative impact on the cable, right? So because this was a dovish signal, the cable or pound dollar actually dropped quite sharply following the release of this statement. However, when Governor Andrew Bailey commenced his press conference, he leaned more on the hawkish side. Right, so these are a couple of the points that I want to highlight as well. So he noted that higher rates are reducing inflation, but MPC members need to make sure that inflation comes down to 2% and remains well anchored around this target. So not only does it need to come down and hit 2%, it needs to remain around this level or even perhaps slide lower for an extended period of time. Right, and he also added that while the current progress is encouraging, right, Governor Bailey, along with other policymakers, have not reached the point of cutting rates just yet. So you can see here, despite the statement highlighting a dovish signal, the press conference by Governor Bailey was actually quite hawkish, right? It was leaned more on the hawkish side rather than being balanced. And that caused the pound or the cable to reverse shortly after as well. So what was initially quite a sharp drop in the cable following the release of the statement, but it actually reversed to climb higher as the press conference was leaning more on the hawkish side. So these were the key takeaways to take note of. And remember, we have an increase in the number of MPC members who wish to cut the official bank rate. Now that could increase as well moving forward, right? In the next meeting, we could see that increase to 3 members as well. All right, then what does it mean for the cable moving forward? Right, so let's take a look at the state of a few macroeconomic indicators for the UK, right? Starting off with GDP. Now, as I mentioned, right, in the third quarter and fourth quarter of last year, the UK actually entered a technical recession. So what's a technical recession? That's basically 2 consecutive quarters of negative growth. So we can see here in Q3 of 2022, it entered negative growth as well, but then it rebounded in the fourth quarter of that year. And moving forward to the second half of last year, the third and fourth quarter registered 2 consecutive months of negative growth, declining 0.1% in the third quarter and 0.3% in the fourth quarter. Now, this results in a technical recession here. However, economic output has rebounded very strongly in the first quarter of this year, with GDP rising 0.6% year over year in the first quarter of 2024. As you can see, this is also the strongest expansion in over 2 years, right? So you can see the first quarter of Q1 was 0.5%, and the fourth quarter of 2021 was 1.5%. So this was a very sharp rebound, sharp and strong rebound in GDP output, which was primarily led by the services sector. right? So although the UK did enter technical recession in the second half of last year, it has rebounded very strongly so far, and this economic output is quite likely to continue as we look at the PMI data up next. Now, trade balance is also important as well. You can see the trade deficit, right? In this case, the UK has been running a deficit, but however, if you look from November of last year, this deficit has been reducing pretty drastically as well, right? It's almost dropped by 75% as well. There are a deficit of about 4.4 billion now, which is about down to about 1 billion, right? So it's a huge uh, decrease in the deficit as well, which generally helps to prop up the value for the pound as well. Now, when we look at PMI activities, right, a PMI is basically Purchasing Managers Index. It measures the level of activity in that particular sector. So on the left, I have the chart for manufacturing PMI, and on the right, I have this chart for services PMI. Right. And just for to take note, for PMI, a reading below 50 constitutes contraction for that particular sector, whereas a reading above 50 reflects expansion. So when you look at the manufacturing PMI data, it's actually been in contraction for most parts of 2022 and even 2020. Sorry, for most parts of 2023 and even 2022. It's only that we're trying to see manufacturing return to expansion in March of this year and as well as in May, right? So May was the strongest expansion since July 2022, right? With a recovery in both export sales and inventory purchases as well. And with manufacturing activity picking up, as indicated by a return to expansion, we are also seeing factory prices increasing as well. And not only are they increasing, gradually they've actually increased at the sharpest rate in a year. Now, with prices increasing for the manufacturing sector, this naturally is going to spill over into the broader economy, right? Into other goods, into final goods as well, into the prices of final goods, and of course that is going to have an impact on the overall level of inflation as well. Although it's good to see economic activity for the manufacturing sector rebound, right? But it's a double-edged sword because as prices increases, this is likely to be passed on to consumers, and then of course that creates a positive feedback loop for inflation, and that's at least going to keep inflation elevated. It may not cause a strong re-acceleration in inflation, but it's going to keep inflation elevated, and that means it's going to take a longer time for CPI to drop down towards the Bank of England's target of 2%. Now, when you look at the services sector has rebounded strongly from the fourth quarter of 2023 as well. Remember, in the third and fourth quarter of 2023, the UK underwent a technical recession that is clearly marked by a contraction in PMI activity as well as services activity as well. But we've since then, especially in the fourth quarter of last year, we've seen a sharp increase in PMI activity, returning to expansion. And also we can see new orders are continuing to grow both domestically and in foreign markets as well. And this was the seventh consecutive month of expansion for services PMI, right? So employment levels are high, edging higher as well. So that's good. And of course, higher wage costs are also involved. So higher wage costs would also mean that the UK consumer would benefit as well. This means their relatively spending power, the spending power is still remains relatively high. Right, so we can see after undergoing a technical recession in the third and fourth quarter of 2023, we have seen the UK economy rebound sharply, and it's also reflected in the PMI numbers for manufacturing and services as well. And then when you look at the composite level, composite is basically the blend between manufacturing and services, and that too, of course, is naturally going to has naturally rebounded as well, moving up into expansion territory as well, right? So this is the level, a reading below 50 is contraction, reading above 50 is expansion. So once again, we're seeing very strong rebound in economic activity in the UK. Now, that brings us to inflation. So here I have the chart for headline inflation or headline CPI on the left and core CPI on the right, both on a monthly basis. So as you can see here, the recent readings, especially in February and March, For headline CPI has been relatively strong, coming in at 0.6%, right? This was the largest reading since May of last year. So February and March recorded strong monthly increases in headline CPI. And at the same time, January, February, March, April has also registered strong monthly increases for core inflation as well. Remember this reading at about, I think this is about 0.9% month over month, was the highest since May of last year as well. So on a monthly basis, inflation does look to be coming in pretty strong, right? We've not seen a down month since January of 2024, right? Whereas you look at the last 6, 7 months, there have been a couple of down months as well. However, now we've seen 3 consecutive monthly gains, and that of course puts upward pressure on prices. Now, looking at the annualized basis, on an annualized basis for CPI, this is headline CPI on the left, and this is core CPI on the right on an annualized basis. Right, when you look at it on an annualized basis, we can see inflation has moderated significantly lower, right, with headline CPI coming in at 8.7% year over year in May of last year, dropping to as low as 2.3% in April. Similarly, for the core CPI, it was as high as about maybe 6.9% in May, dropping to as low as 3.9% in April. Although when we look at inflation on an annualized basis, it's heading in the right direction. It is trending lower. But however, when you look at it on a monthly basis, it tells us a little slightly different story. Now, if this monthly data continues to come in at around current levels, we may see this downward trend in inflation on an annualized basis sort of stabilize and maybe even see a reacceleration. Now, if you see inflation reaccelerating on an annualized basis for both headline and core CPI, that's of course going to have a major impact on whether the Bank of England is going to move forward with any potential rate cuts, right? Once again, this could then mean they're going to likely to maintain rates at current levels, which is quite likely to keep the pound elevated as well. Now, home prices as well. So as bank rates increased rapidly, mortgage rates increased as well. So this was reflected in home prices throughout 2022 for most parts of 2022 and 2023 when you look at the annualized home prices, right? It had decelerated. Remember, this is a reading of 0%. So this shows a deceleration in prices or a drop in home prices. However, since the fourth quarter of last year, we've seen a rebound in home prices as well. So with home prices rebounding higher, that also feeds into overall CPI figures as well. Right, so should we see home prices accelerate in the second quarter and third quarter of 2024, that's also going to create another or pose another problem for the Bank of England, because that means overall inflation is likely to remain sticky as well. We may see this acceleration occur. Right, and finally moving on to consumer spending. Now, consumer spending has been pretty weak in the UK, right? When you look at it on a monthly basis, on the chart I have on the left shows retail sales on a monthly basis, and you can see that data has been very patchy. You have seen alternate months of declines and alternate months of increases. And when you look at it on an annualized basis, you can see retail sales have actually been pretty poor. For most parts of 2023, they've actually decelerated, and it's only now, even now, it's a very patchy reading. So we can see that the UK consumer has actually fallen off more than the US consumer with regards to spending, right? Despite higher wages, they are not uh, spending as much, right? Consumer spending has been somewhat curtailed due to higher interest rates as well. And part of the reason is also due to employment change and the unemployment rate, which we'll get to in the next slide. Now, when we look at employment, we're going to look at employment change, which is the monthly employment changes, like the equivalent of the non-farm payrolls for the UK, and we'll also look at the unemployment rate. Now, when we look at the unemployment rate, we've seen it increase sharply from about 3.8% or 3.7% in December of 2023 to as high as 4.3% in March. This is also a similar acceleration that we saw in unemployment rate in the first half of 2023. Now, of course, if unemployment rate is rising, that means there are more people becoming unemployed, of course, and that also is reflected in the monthly change as well. So what we had 3 months of job gains from October to December of last year, we're actually seeing job losses in the first quarter of this year. So naturally, if people are losing their jobs, unemployment rate is rising, consumer spending is going to be impacted as well, right? No one's going to spend if they are losing their jobs. So this we have to see whether this trend is going to stabilize and reverse. We saw that happen in the middle of last year. Unemployment change went negative. There were job losses being incurred in the middle of the year over a period of 4 months, and around that same time, of course, unemployment rate spiked up as well. Now, is this just a temporary shift in the direction, or are we going to see further job losses for the UK economies? Now, this is something to keep a close eye on, because if we see further job losses and we see further increase in the unemployment rate, of course, consumer spending is going to be curtailed even further. And should we see a sharp spike in the unemployment rate, maybe going above 4.5 or coming close to 5%, that may even cause the Bank of England to move forward with its first rate cut, despite inflation still being relatively sticky. Remember, inflation has not reached the target of 2% yet. But if we do see a potential break in the labor market, and what do I mean by that? That means we see employment change going more negative over the next few months, right? More job losses being incurred, and at the same time, we see the unemployment rate rising higher. That may be enough to cause the Bank of England to move forward with its first rate cut in a bid to try and stimulate the economy, right? Okay, with that, now that we have a relatively good idea on the state of the UK economy with regards to employment, consumer spending, home prices, inflation on an annualized basis and monthly basis, and also looking at PMI numbers for the composite, manufacturing, and services sectors, and also looking at the current trade balance and GDP, right? We got a good sense of the state of the macroeconomic conditions in the UK. Now, with that, let's move on over to the charts on TradingView and see where the pound is currently trading. Right. Okay. So here I am on the chart for the British pound, pound dollar, otherwise known as cable. I'm on the daily time frame here. Now we can see since the third week of April, cable has stabilized around 1.2350 and has rebounded strongly since then, coming very close to 1.2800 here. Now this is a strong bullish move, and also because we've seen that sharp rebound in economic activity in the UK, we've also seen the trade deficit narrow, right? We have seen stronger demand for the pound as well versus the dollar. So right, so you can see here as well, and also that combined that with softer inflation in the US. Remember, the recent US data has been relatively has come in soft now, so that has also caused pound or cable to push higher as well. So we have to take note of the differentials between the macroeconomic conditions in the UK and the US as well. Now, quite clearly, this let's just start to talk about a little bit of the technicals so we can try and identify where the major resistance and support levels are and how we can try and identify the next opportunity for this currency pair, right? You can see pound is trading in a nice bullish channel, right? This is a nice bullish channel here. And previously it was trading in a very nice bearish channel as well here, which finally got taken out in the end of April and early May, right? There's a strong bearish channel here, which finally got broken out of, right? Also, we can see that this is a nice pullback resistance level here at about 1.2786, which is where the pound seems to have run into resistance once again today, right? This is a pretty significant pullback resistance level here, and this is quite clearly going to be our first resistance. Second resistance is going to be the swing high that took place on the 8th of March, and that's at 1.2858. Right, we can also run a Fibonacci retracement starting from this swing high on the 8th of March going down to the swing low here on the 22nd of April. I believe there may be the 78.6 that we could use. All right, okay, 78 has actually been surpassed, but I'll just like to highlight it as a zone. You just keep this in mind here, that this pullback resistance also has the presence of of 78.6% Fibonacci retracement. Just improving the opaqueness of this so it's a bit more clearer. Yep, there we go. So we can see here, right, this is a pretty significant resistance area for the pound, for the cable at this pullback resistance at 1.2790. There's also a 78.6% Fibonacci retracement here, right? With regards to support, you can see there's a pretty decent overlap level here as well, right? You can see here previously this level at 1.2683 previously functioned as a strong resistance back on 4th of April, 9th, and the 10th of April. Even functioned as resistance here on the 15th and 16th of May before finally breaking higher. And when it did break higher, it found nice support on the 23rd and 24th of May before finally going higher as well. So this creates a strong overlap support level at 1.2683, which we can use to identify as our first major support. Right, we can also run a Fibonacci retracement, right? Starting from this swing low on the 22nd of April, going up to the high here of today. Let's pull up all the fibs. You can see that the overlap support at 1.2683 also has the presence of a 23.6% Fibonacci retracement. And also there's another nice overlap that I see around the 50% Fibonacci retracement as well. So let's keep 23 and 50. Right here we can see a pretty decent overlap, pretty good overlap level here as well. Right. So now that we've seen what are the clear where are the major resistance and support levels for the pound, right? And we also know it's trading in a nice bullish channel. Right now, let's just zoom on down to the 4-hour time frame and see if we can fine tune the analysis. Right. So you can see here, right, it is pulling back. Just adjust the first resistance a little bit. Just capture the top of this swing high resistance here. So you can see that this is a pretty significant resistance area. And take note, we've also got PCE price index data out of the US today. Sorry, not today, this Friday, right? That's a personal consumption expenditures. That's an inflation data point. So should we see softer than expected PCE data in the US come Friday, that of course is quite likely going to cause the US dollar to sell off. So that means we could potentially see a strong bullish catalyst for the cable come Friday. So in the meantime, maybe we're going to see cable pull back, right? And should it manage to stay above the first support at around 1.2700 come Friday and combine that with a softer than expected PCE data point, that is quite likely going to cause a strong reversal for the cable, right? So take note. So maybe by the time we get to Friday, cable is probably trading around close to 1.3700 maybe, right? And then should it stay above this level here and we see softer than expected PCE data out of the US on that day, it's quite likely going to function as a bullish catalyst for the pound and we could see cable push up higher once again. Right. So for now, it's definitely pulling back. Right, it's definitely pulling back. You can see now, I would like to identify a couple of intermediate support levels as well. And I see a pretty decent intermediate support level at 1.2743. Right, previously this level was resistance from 22nd of May till 24th of May. So for a period of 2 to 3 days, this was resistance. And with price breaking above it, what was previously a resistance could now potentially be support as well. So take note, if we do see this support level here get taken out, then of course cable is likely to drift lower. Right, let's see if there's any other Fibonacci retracement that we can use as well. Okay, first support, maybe I'll just try and see if there's a need to fine tune the first support a little bit. Yeah, I think this should be fine. This should be good enough here. And let's see, there's another, I think we can probably do run one more Fibonacci retracement from here, 9th of May, going up to the high here. We can also see there's another 23.6% Fibonacci retracement here as well. So this level here at about 1.2700 does look like to be a very strong overlap level, right? It's a strong overlap level. There's the presence of a 33.6% Fibonacci retracement from this uptrend here. And then there's another Fibonacci retracement, 33% from the larger move as well. Right, so take note, dollar is, when you look at dollar index today, it is rebounding off a pretty significant support level, right? This is a pretty decent intermediate support level here. It does seem to have rebounded higher. Maybe this is going to retrace higher for the next 1 or 2 days. And of course, if that happens, cable is definitely going to pull back more. So take note, this is an intermediate support level for the cable at 1.2743. If this level doesn't hold, right, then we may have a potential bearish breakout. And that bearish breakout could cause it to fall down towards the first support here. Now, when we come back to the PCE data on Friday, we may see prices consolidate around 1.2700, and we may potentially see cable push higher on that day itself, especially if PCE data comes in softer than expected. So take note of that. So with the UK economy looking strong, right, is looking strong, PMI activity rebounding strongly, and the economy has come out of a technical recession. We could see, and with inflation remaining quite sticky as well, we could see the pound move higher as well. But of course, nothing moves up and down in a straight line. So any pullbacks in the pound, especially if this level at 1.2700 holds, is likely to identify or present itself as a good opportunity to go long on the pound once again, right? So take note, the pound is also trading within a bullish channel, and we see a strong support around 1.27. So if this area holds, right, should there be any strong pullbacks in the pound and it holds around this level here, it is quite likely we may see prices consolidate and then may give us another opportunity to go long on the pound once again. Right, so these are the key levels for the pound, for the British pound or cable that we have. Is there anything else that I can try and identify? No, I think this is pretty much it. If anything, I can just draw one more Fibonacci retracement starting from here. This low on the 24th of May, last Friday, going up to today's high. There may be a 38% that I see, right? There's a 38% that aligns very well with the overlap, with the pullback support here. Right, so take note, this is a pretty key level for uh, the cable in the near term. 1.2743 is a key level for the cable in the near term. If it doesn't hold, right, we're likely to see a bearish breakout occur, and then we could see a move all the way down towards 1.2700. And this is the first major key level here on the longer term, on a medium term outlook. So if this level holds, right, and we see a nice rebound here, we're quite likely to see cable continue or resume its bullish uptrend, right? So take note of these are the key levels here. Now, of course, we can't just when we do our analysis on the pound, we also have to look at how the dollar index is trading. So let's try and do that as well. Right, so looking at the pound, the dollar index, let's look at it on the daily time frame. Right, so we see it's been in a bearish downtrend since the 1st of May, right? We see a series of lower highs, series of lower lows, indicating a strong bullish bearish momentum. And at the same time, there's a nice bearish channel as well. Right, so with dollar index falling, right, we look at it on a daily time frame, it's been falling strongly over the last 3 days. But of course, it does look like to have found a little bit of support around 1.0440, right? So when you look at it on the 4-hour time frame here, remember as I mentioned earlier, this was a pretty decent intermediate or near-term support for the dollar index at 104.28, which is also where prices once again stalled. It previously found support here on 16th of May, 17th of May and the 20th of May. So for a period of 3 days, it found pretty decent support around this area before bouncing higher. And it does look like to have found support once again early today as well. Now, so with dollar index retracing higher, naturally cable is going to pull back, right? So take note, we've got the near-term level at 1.2743 and a major support at 1.2696. All right, so coming back to dollar index, right? So we know that this is a pretty decent intermediate support level here for dollar index. The next major support level is going to be the swing low that occurred here on the 16th of May. So this is where the first major support for the dollar index would come. So should we see dollar index reverse and drop lower, breaking through 104.30, right? That means it's quite likely we're going to see the dollar index drift down towards 104, right? So this is where we would see dollar index push down lower. And as it reaches this level here, okay, first of all, if it breaks below this level here at 104.30, that may help tell us that we have an indication to go long on the pound, right? Remember, if dollar index is falling, pound is going to go higher, cable is going to go higher. So if we see this bearish breakout occur for dollar index at around 104.30, we may have a potential bullish opportunity for the cable. And then as dollar index reaches or comes close to the vicinity of the first support, that should be an area which that should be a signal to tell us that we should be looking to exit our long cable positions as well, because this is a major support level for the dollar index here at 104. And it's quite likely any downward fall in the dollar index is likely to stall around this region. So that means any rise in the cable is also expected to slow down or stall as well. So as dollar index, okay, so should dollar index reverse and drop below 104.30, that gives us a potential bearish breakout signal, and that means it's a we may have a good opportunity to go long on cable. And as dollar index comes close towards the first support at 104, that's also giving us another signal to tell us that it's quite likely we have hit a potential take profit level for the long cable position, and we should be looking to at least book some profits on that position or run a tighter stop loss. So you can also run a Fibonacci retracement here for the dollar index from this part of the move, 16 May going up to the high on this 24th of May, right? I think there's a 61 or 78.6 that we can use. All right, okay, 61 is just there. So it's around the vicinity of the 61.8%, right? It's not exactly at 61.8%, but it's around this region where the pullback support sits at 104.30, and the 61.8% Fibonacci retracement is where the dollar index has found strong support, right? So not only do we have a pullback support level at 104.30, we also have the presence of a 61.8% Fibonacci retracement, highlighting a major support zone as well. Right now, we can see clearly since last Friday, dollar has been selling off. We may see it retrace a little bit higher, but remember, any reversal and a break below 104.30, 104.30 is likely going to cause pound or the cable to move higher as well, right? Okay, so these are the key levels to watch out for the cable as well as for the dollar index, right? Okay, so let's just wrap up today's session, right? So we had the Bank of England release its monetary policy statement about 2 weeks ago on Thursday, 9th of May at 11 a.m., right? They kept their official bank rate on hold at 5.25% as widely expected. However, there was a change in the number of MPC members who wished to reduce the rate. So previously, they had a majority vote of 9-0 previously in previous meetings, and then in the last few meetings, that reduced down to 8-1, and finally it's reduced to 7-2, although it's still a majority vote. We now are starting to see more MPC members preferring to reduce the bank rate by 25 basis points or a quarter of a percentage point. So this is a dovish signal, which is what initially caused the pound or the cable to sell off when this statement was released on Thursday, 9th of May. However, right, we saw and Governor Andrew Bailey come out to be pretty hawkish during his press conference, right? So because of that, we saw the cable stabilize and reverse to bounce higher as well, right? So after entering a technical recession in the third and fourth quarter of last year, we are seeing a strong rebound in economic output or GDP output for the UK, rising 0.6% in the first quarter of this year, which was the highest level or strongest expansion in over 2 years. We're also seeing the trade deficit narrow, going from about 4.5 billion down to about 1.1 billion pounds. That's a huge drastic uh, change in the deficit levels in a positive way, which is usually going to be supportive for the cable as well. And at the same time, we're seeing manufacturing and services activity in the UK return to expansion, which is of course, going to drive overall economic growth. So, of course, composite PMI is also rebounded nicely. Inflation is a bit sticky, right? When you look at it on a monthly basis, headline inflation, which is on the left, and core CPI or core inflation on the right, we can see they are hitting levels that are relatively high, right? 0.6% month over month in February and March, and then a slowdown to 0.3% in April. Whereas for the core, you can see it is still hitting relatively high numbers, 0.5 or 0.6% in February and March, and hitting about 0.9% in April. So on a monthly basis, inflation is still uh, rising quite strongly. When you look at historical data, and at the same time, we've seen 3 consecutive months of increases, right? We've not seen a down month since January of 2024, right? We have seen 3 consecutive months of higher prices, and we've not seen any down months as well, which is quite likely going to cause inflation to be sticky as well. When you look at inflation on an annualized basis, it's heading in the right direction. It is trending lower, but when you look at it on a monthly basis, we may start to see inflation on a headline base on an annualized basis start to stabilize, and if prices does increase further, right? If home prices continue to rise higher, factory prices continue to push high as well, we may see a potential minor rebound or re-acceleration in headlines and core CPI on an annualized basis as well. Right, home prices, as I mentioned, right, higher bank rates lead to higher mortgage rates, which cause home prices to which cause demand for housing to pull back, and of course, home prices dropped along with it as well. So we saw a nice deceleration in home prices in the UK throughout 2023. However, coming into the fourth quarter of last year, we're starting to see home prices re-accelerate as well. Now, of course, this will then feed into CPI data as well. So uh, if home prices continue to climb higher, that of course means inflation is going to be more sticky and also could potentially cause it to re-accelerate as well. Now, consumer spending is pretty poor in the UK when you look at it on a monthly basis and on an annualized basis, especially in the first quarter of 2024. We've seen 2 consecutive down months here, and this was the reading for April at negative 2.3%, falling 2.3% was the largest decline since December as well. And part of this drop off in consumer spending can be attributed to the labor market or the weakness in the labor market, right? We have seen a acceleration in the unemployment rate or the unemployment rate rising in the first quarter of 2024. And at the same time, we are seeing the UK labor market actually lose jobs, right? Following 3 consecutive months of job gains from October to December of last year, the first quarter has actually seen the UK labor market lose jobs as well, right? So, of course, with jobs being shed in the economy and with the unemployment rate rising, that is of course going to have a negative impact on consumer spending as well. Right. Okay, so with that, I will just wrap up today's session. Right. Thanks everyone for tuning in to today's webinar, brought to you by Vantage Markets, where we covered the central bank spotlight, and this time specifically was the Bank of England, how they what was their main reaction to the latest meeting, what was the outcome, the key takeaways from their statement and the press conference. And we also looked at the current state of macroeconomic conditions in the UK and how that could impact future policy decisions and as well as drive the direction of the cable as well. All right. Okay, with that, thanks for everyone for tuning in today. Hope this has been a great session, and look forward to catching you at the next webinar as well.